advisor, the Series 65. The alternatives, we need to have the Series 7 securities license. With the safe money, you need to have your insurance license. And we all are required to have those licenses at Tremblay Financial Services. Then as you go in, this is the growth mode, we move to the income mode. Now we're going to convert this portfolio to sending income to the checking account of our client. The alternatives, instead of dollar cost averaging into the managed account, are now sent directly to the checking account. The managed money moves from a growth managed portfolio to an income-based managed portfolio. The safe income, the indexed annuities, we turn on the income immediately. Now, oftentimes clients can change. We've had clients come in and say, geez, I retired, I need the income now. So we set it up in the income mode, and come to find they get a job as a consultant. Well, then it's very simple with a signature and a phone call to move from the income back to the growth. So this triad asset allocation is very flexible. It gives us an opportunity to really manage our client's portfolio for who they are financially. As you're younger, you're going to have more of the portfolio in the managed money, in the stocks and bonds portion of the portfolio. As you get older and closer to retirement, we're going to migrate that portfolio more to the safe and the conservative investments over time. So it's a tremendous tool that we have at Tremblay Financial. It's been very, very valuable to our clients, especially during these difficult times. I want to tell one story before I bring our featured speaker on. Right before the coronavirus hit, the markets were right close to their high. And I got a phone call from a client, well, a prospect at the time. And this referral said, geez, I'm going out of the country, but I'm going to retire soon. And one of my very close friends recommended you. I'd like to maybe talk to you, but maybe I should talk to you after I get back from Australia. And I said, well, let's get you in here on a Saturday. I know you're leaving on Monday. Let's see what we can do, because who knows what might happen with this market as you leave. So sure enough, we met on a Saturday, went through a financial plan, spent some good time together, really finding out who they were financially. And then I said, you know, you really should do this before you leave. So the next day, Monday, that we were able to contact the 401k, the retirement, we contacted them and said we would like to do a IRA rollover. And so it was a significant part of his net worth. It's something he'd worked his entire life for. We were able to come out at the high of the market, transfer it, no tax, no cost, into his individual retirement account. And we set up a triad asset allocation. And that afternoon, he went and got on his airplane and took off with his wife. And it was the next week that the coronavirus hit, and we saw the markets collapse. He not only didn't lose a dime, he's made money in this triad asset allocation. And had he not done it, he would have lost significantly, 30% of his portfolio. And it would have forced him to have to put off his retirement for some time. That's just one of many stories that we have with our triad asset allocation and this approach that we've embraced at Tremblay Financial Services. So we're proud to bring this to the table. And now it gives me a great deal of pleasure to introduce our featured speaker for our webinar this evening. Jason Van Dusen is the Vice President of Bluerock, and he's been a part of our team for years now at Tremblay Financial Services. We're proud to be able to offer what Bluerock brings to the table in the alternative or non-correlated portion of our asset allocation. Ladies and gentlemen, at this time I'd like to present Jason Van Dusen. Jason, take it away.
Tim, thank you so much. I appreciate the introduction. I can tell you, as somebody who's been doing this for a pretty decent amount of time, and Tim and I have been partners now for years, there's a lot of financial advisors to choose from, right? There's a number of them, whether you're in Santa Barbara, whether you're in Ventura County, Orange County, LA, you can go anywhere and find a financial advisor, but there's only a few of them that truly get it And you've got to have, I mean, I can't highlight enough what Tim was talking about, in that it's easy in a bull, but it's tough in a bear. And I loved it. I even wrote it down. I said that was an exact statement, which is more true than ever, especially now. You've got to have the experience. You've got to know how to navigate markets. It's easy to sail in calm waters. It's a heck of a lot tougher in the chop. And so you got to be able to have experience to know how to do it. And we have that same experience here at Bluerock Capital because we've been through it before. Again, I'm one of the senior vice presidents here at the firm. It's been a little different than usual. I've been doing a lot of these sort of Zoom or WebEx, Ring Central type meetings. I'm used to spending 100 to 150 nights a year in a hotel room, traveling coast to coast and living the suitcase life. But anyway, it's been different, but I can tell you it's been enjoyable to a degree as well. You get to spend more time with the family for sure. So now more than ever, it's a time to really take a step back and become a student of the market. And if you don't want to study the stock market, take the time to just go outside, especially in a pandemic situation like what we're in now. If you want to figure out what may potentially work, not only now, but down the road, go outside. I don't know about you, but every time I open up my front door, it's like I've got an addition on my home with the number of Amazon and Target boxes and all these other things that we have coming to the house. So I know for Amazon specifically, that's been doing great, right? Not only as a stock, but also as a company itself, they've been thriving, right? I mean, I know when I drive down the street and go to the store to run an errand, with my mask on, of course, and gloves, there's more FedEx, UPS, Amazon trucks more than ever. So people are delivering things to their home. So think about that when it comes to real estate. What asset class would benefit from that? What asset class? Industrial, right? Warehouses, distribution, manufacturing, storage. All of these asset classes have actually coincidentally thrived in these times. Just because the stock market, like Tim said, went from kissing 30 Dow, right? 30,000 of the Dow all the way to the bottom at 18. And now we've rebounded into the mid 24s, I believe, if I'm correct up to today. That doesn't mean, though, that all asset classes and all commercial real estate has reacted the same. Some commercial real estate has been affected and some have not. And it depends as a company, if you've been through technical situations like the savings and loan crisis, the great financial crisis, or you've been in situations like 9/11, Y2K, .com, now COVID, which quite frankly, COVID is going to be one of those things included in all charts moving forward to see on how real estate, whether it be commercial or residential, equity markets, all investments, how they reacted during this very, very sharp decline that we saw. And so it's important to kind of understand what worked now, even in this volatile of a market, because hopefully it'll continue to work moving forward. And we've seen with enough of a track record and having been in this business long enough, there are certain asset classes that, whether it be in a bull market, like Tim said, or more importantly in a bear market, these asset classes will not, will not be as impacted as the equity markets will be. Okay, so again, try to become a student of the market. Another asset class that has done really well right now has been multifamily, apartment complexes. Because if anything, you got to keep a roof over your head. Whether you're employed and you're still getting an income, or you're unemployed and you're getting the stimulus and the extra payments from the government, your first check is probably going to go to keeping a roof over your head and paying your rent, right? So multifamily has actually been doing very well. Tech companies we've seen do well, but really in regards to real estate, which is what we specialize in, the multifamily sector has done very, very, very well. And that's been one of our biggest concentrations as a company. So at Bluerock, we've been around as a company since the early 2000s. All of our executive members have been in the business for over 30 years at minimum, all coming from the institutional world. We founded Bluerock in 2002. We're based out of Manhattan, New York. We have offices throughout the country, and then we also have an office where I live, which is very convenient to say the least, and that's in Newport Beach, California. So I'm typically used to doing these events with Tim there in Westlake at the Village Inn, or up in Santa Barbara at the University Club, but this has definitely been a little bit different and quite frankly enjoyable. So at Bluerock, like I said, we have 3 verticals within our company. One is 1031 exchanges. So for those of you that are on here that may own investment properties and you're looking to find an opportunity to sell but not have to pay the capital gains tax, be sure to talk to Tremblay Financial and meet with them and have them give you the information in regards to what a 1031 exchange and what a DST, Delaware Statutory Trust, is. That's crucial and important, and there's some great opportunities out there right now for that type of business. We also not only do 1031s, but we have a mutual fund investment. It's a mutual fund investment that has concentrated on more of the recession resistant. There's no such thing as recession proof, but recession resistant asset classes, i.e. industrial, multifamily, those right there, that encompasses probably 70+% of our portfolio. We've got very little retail exposure, the high touch real estate, if you will, which is what we like to call it, which would be like your movie theaters and restaurants, or your Neiman's, or your Nordstroms, if you will, that are being highly affected right now. The malls, the Sears, the JCPenney's. We have very little exposure in that, no exposure in hospitality. And then we have a little bit in office. Now, office, certain segments of office have done well, like your central business district in Chicago, New York, LA, the 24-hour markets with the major corporate tenants. Those have actually done well, and that's most of the holdings in that portfolio. We've been able to continue to pay out distributions, and we actually, since January 2nd, our stock price, if you will, or net asset value is what they call it, has only gone down a little over 1%. So think about that, only a little over 1%. So it's done very, very, very well. And then the third one, which is what I want to talk to you about today, and Tim and I and the group we work actively on, is called the Bluerock Residential Growth REIT, BRG. And it's the Series T redeemable preferred stock offering. Okay, so let's hit a little bit more into why multifamily. What is it about multifamily that's attractive to us? Before I go into how the preferred stock works and the nature of that investment, let's talk more about multifamily. Who lives in multifamily properties right now? So usually if I was with you guys in person, one of the first questions I'd ask is, what is the biggest population group right now? Is it the baby boomers or is it the millennials? And I'd usually ask for a show of hands. So I'll do the hands for us here. Well, it's the millennial population. The millennials right now are the largest. Thank you, Judy. I appreciate the chiming in on the chat. The millennial population is the largest population group today. They've exceeded the baby boomer population significantly at this point. The millennials now are a heck of a lot different than what the baby boomers were at their age. Okay. And what I mean by that is everything is on demand right now, right? From Ubers to scooters to, all of that. You can get everything on demand. Amazon packages. Right before I started with this, I had to answer the door to pick up another package. So everything's on demand, and that's what the millennials want. It's no longer about graduating college with your high school sweetheart, if you will, and you guys get married and have kids and you live 45 minutes out of the city. Most now are living in areas that they want to live in, which would be the kind of the Sun Belt area is typically where you're going to find most millennials moving to, which is not your 24-hour cities like your Chicago, New York, LA's. It's your Nashville's, which Nashville, by the way, is a red hot area. We've actually had one of the most successful, what they call full cycle events, but one of the most successful sales ever in the history of this in the 1031 exchange business out there in Nashville. the Carolinas, where I actually coincidentally went to school, Georgia, Florida, Texas, Denver, Boston. I mean, just super red hot markets, and they want to live adjacent to a quick Uber, walking, again, scooter, don't scooter. I almost killed myself one day in a scooter, and I vowed never to do it ever again. But, scooter ride away, you can get to, the grocery store, the, restaurants, bars, shopping, things to do, activities, and places to meet with people. So that's what the millennials want. And plus two, when they would get, again, this is pre-COVID and soon to be after all of this is done, when stimulus checks would come or tax returns would come, if they had one, they would kind of lock up their place and go to Bali and take selfies and post them on Instagram. That's where it's no longer, they don't want to put as much money away. It's more now experiential, right? Anybody that has kids right now, it's all about experiences. I want to experience this and take photos of it. That's what is going on. So many of them are living by choice, okay, not by necessity, in multifamily properties or apartment complexes. And a lot of these complexes are tailored to the millennial generation. Okay, so we have a portfolio here. Oh, actually, you know what? Before I even go into the portfolio, let me show you this next slide here. So this is showing during the great financial crisis why, out of all asset classes, you'd want to invest in a multifamily. And now they have charted on here in the darkest bar to the left in each one is multifamily. Green is industrial. Blue is office, and gray is retail. So what you've seen is that rental rates and this was in the Great Recession, so over I believe it was a 3-year period is how they had this charted. Rents went down the least in multifamily, only about 8%, but more importantly, they were able to recover. If you look at the second portion of the slide, they were able to recover not only the fastest, but the greatest compared to all other asset classes. So showing that in a different way. But the bottom, if you look at the bottom of that chart, it's from Q1 of 2008, so quarter one, so the beginning of 2008, until the second quarter of 2018, so a 10-year period. Multifamily in blue, so it's the first line, had the shortest negative trend in rents. So rents went down for a couple quarters. It was 5 of them, to be specific. It then recovered back to what it was originally in only 7 months, and then spent 29 quarters growing past its previous peak. 29 quarters. All other asset classes took longer. They had a longer negative downtrend, took longer to recover just back to even of what you were previously. And then only 2 of those other 3 actually exceeded that, and industrial being one of them. So again, the strongest case is multifamily. And again, no asset class is recession proof. But what you're investing in real estate is that if I can be in an asset class and potentially do a little bit of better performance and provide greater stability than my equity markets, then that's a reason for it to be a portion of my income, not only including the portion of my portfolio, not even including the income, of course. Multifamily has always provided in the last 38 years or so, 37, 38 years, has always provided greater returns with less risk than any other asset class. And kind of the 4 pillars, if you will, of commercial real estate is retail, industrial, multifamily, and office. And multifamily has always had the least risk with the highest return. So what we have here at Bluerock is that we have a portfolio that we have built over the last going on almost 7 years now, actually. A little over 7 years, is a portfolio that is publicly traded on the New York Stock Exchange. The ticker symbol is BRG. And you can see it on this slide. And what that is a publicly traded portfolio of real estate, or what they call a REIT, real estate investment trust. And what we do is we go out and we source and we buy multifamily properties along that Sunbelt area, like I talked about, that is very appealing to many of the millennial population. Again, if you created, a smiley face on the map, where the mouth is where we're buying them. Again, Boston, the Carolina, Virginia, North Carolina, South Carolina, Georgia, Florida, Texas, Arizona, Denver, Boston, if I didn't mention that, just red hot markets to where the millennial population is moving to because it's very attractive, and they're moving there by choice. Now, let me just throw this in there. We concentrate specifically on A assets, the highest quality assets. So the question is why is that important? And I'll pretend like I'm the audience, and I know naturally a question will come up. Well, why A? I'd rather buy a C property right now where it's more affordable for people to live in. And I'd always say I appreciate the question, but at the end of the day, think about this. An A asset is the highest of asset class quality that you can buy in multifamily. The tenant base is much different in an A than what it's going to be in a C, okay? Now, a C-level asset, the average rent in a C-level property, we're not talking about California, but what we're talking about is in general, in a C-level asset is anywhere between $600 to $800 a month. The income, think about this, the income generation, the amount of income that most of the tenants generate in a C property is only about 2 times their rent. That's a fact. So 2 times their rent. So if the average rent's $600 to $800 a month, they're only generating about $1,200 to $1,600 a month in income, and half of that's going to the rent. Whereas in an A asset, it's about 4 to 5 to 1, 4 to 5 times their rent. And the average rent in an A is about $1,100 to $1,300 a month, and that actually applies to our $2.5 billion portfolio of real estate that we have right here within our portfolio. So that's why we concentrate on A. Even with COVID going on, there's a lot of tenants that can afford to continue to pay rent. If it was anything like me, who I typically travel for a living all over the country and international, for me, I just downloaded the software and I was off running and back to work. So it wasn't much of a difference for me. So what we're doing here at Bluerock is we're offering an opportunity to invest into this BRG portfolio that we're growing with the dollars and the capital that we raise, but in a very unique way, and that's through what they call a preferred stock offering. And what that means is that in the first bullet point there, you are senior to the common stockholders, okay? In a publicly traded fund, you have your common stockholders, or what you call your equity, and right below that, you have your debt, okay? So what we're doing is we're adding a little bit of an extra layer, and that's on top, and that's called a preferred stock. You are senior to the common shareholders. The common shareholders, almost 90% of them are the biggest institutions in the world. Vanguard, JP Morgan, Blackstone, BlackRock, Goldman Sachs, CalPERS, they all own this portfolio, but on the common side, we're giving the opportunity to be a senior position to them and be in a preferred stock. Secondly, we actually have what an institutional fee focus. And what that means is that we waived all fees on this portfolio. There are no fees. And any fees that typically you would receive as a investor, we passed on and we made the common stock shareholders pay for that. So if you put in, say, 10 grand or 50 grand, whatever the number is that you put in, that will reflect fully, and that's the third line, that will reflect fully on your statement. So think about that. Most other investments, and I've done them myself, my own personal and my own family money, you put in, say, 100,000, 15 to 20% of that is just gone. They're just gone. They use that to pay themselves and pay property managers. All that's gone. With this, you put in the amount and it will show that amount, and that full amount is going to work. And any fee that would have come out is being paid for by the common stockholders. Fourth, we're paying you a dividend. So not only are you senior to the common stockholders, so you're senior to Goldman, JP, BlackRock, Blackstone, all the biggest CalPERS, but secondly, you've got no fees. You get to see full value on the statement. But on top of that, we're going to give you income. And the income generation alone typically meets most people's needs. And that dividend is 6.15%. If you put in $100,000, that's $6,150 a year, paid out monthly. So 500 and what's that, $10 or whatever and change a month, you would receive an income. And also you have the opportunity to reinvest. If you don't need the income, reinvest it back in and compound, right? That's just a 101 of investing. If you can compound, then compound, because that will get significantly greater over time than if you just took the income. But if you need it, take it. It is a phenomenal income, and it's fully covered by our portfolio, meaning the rents are paying for that. It's not like new money is coming to pay that. And also for an extra kicker, we'll give you every single year that you're in the portfolio, we will give you extra shares of this preferred stock based upon your investment amount. So you get extra shares. And again, Mike or Tim or anybody from the Tremblay Financial Group can help you understand how this all works from a breakdown standpoint based on your investment. And then lastly, there is liquidity, okay? You have full liquidity day one after you invest. But there's a caveat. There's always a catch. There's a penalty every single year until after only 4 years. 4 years. After 4 years, you can either continue to stay in, which most of our shareholders have done, or what you can do is you can go ahead and place a request for redemption, and then we will redeem you out of that portfolio. Okay, so right now, so again, just a quick recap. This is a $2.5 billion, and I'm running 2 minutes late here, so I apologize. But we have a publicly traded portfolio called BRG. We're giving you the opportunity to buy a preferred stock that's non-traded, so you don't see the volatility on the daily basis. You're senior to the biggest institutions in the world. You have no fees, no statement changes. You get a fully covered, fully protected, very, very strong, 6.15% annual dividend, paid monthly. You can reinvest if you want to compound. We give you extra shares for free every year, and you have liquidity if need be. Right now, more than ever, you've got to diversify a portfolio. You can't strictly play in the equities. I've been working with Tim and his group there for years and years and years. I love the triad approach. You want to have a sleeve in alternatives to protect on the down and protect on the volatility. From January 2nd to today, when you saw the Dow run up to 30, down to 18 now in the 24, unfazed. We were unfazed. Dividends still being paid, no disruption in the income, and the portfolio is very well seated. So I want to thank you guys so much for the opportunity. I look forward to hopefully getting to meet you guys in person if I haven't already at some point here soon. And I'm going to pass the mic off here to Tim.
Thanks so much, Jason. We really appreciate it. And you can all see why we're so happy. We're grateful that we have Bluerock as one of the fine investments in the alternative, the non-correlated space in our asset allocation, the triad. We hope you found this webinar helpful. A lot of material, a lot of information in a short period of time. We'd love for you to take advantage of our personal financial consultation. Let us find out who you are financially and show you how we can help you meet your investment goals, your retirement goals, whatever they might be, in the best way possible, regardless of what these markets might bring. We truly would love to show you what we can bring to the table over the long term. Let us know if we can set up an appointment. We appreciate having you here this evening. We'll be doing more of these webinars down the road. We believe this is something that we're going to do from now on as a part of our program at Tremblay Financial Services, reaching people via the webinar mode, the Zoom mode. So with that, good night. God bless, and we'll be looking forward to hearing from you Any folks that set up an appointment and you're a newcomer to Tremblay Financial, we have a $50 gift certificate, a gift card that we'll be sending you as a token of our appreciation. So with that, we bid you a good night and thank you so much for attending.